by Shelter Island Risk. Our topic this morning is how to enhance risk management in your organization. Let me introduce myself. I'm Rick Denning, President of Shelter Island Risk. We are a consulting group that has been focused on the often large gap between the data you have and the information that you need. And I think you'll find that many risk managers have really made their mark in their organizations by exploiting this information potential that their data does provide. The program this morning involves two very experienced and very qualified risk managers that I would like to introduce at this point. The first, Patty Furterer, is Vice President of Insurance and Risk Management at First Group. For many of your listeners, you may not be familiar with what First Group is all about, but when I explain, I think you will realize that their mission is one of the most critical you can imagine. They are the largest provider of school transportation, bus transportation in the U.S., with some 60,000 buses and some 90,000 total employees carrying around our kids on the mornings and afternoons of a typical school day. You can imagine the risk management responsibilities that Patty faces are not just financial, but extend into just about every dimension of risk management. Patty was a risk manager coming from the carrier insurer world. She had a stint at Liberty Mutual, and while she was initially focused on law, she has brought those skills and capabilities to risk management. She handles a range of issues within her department, as most of you would, but she takes a particular interest in the data and in communicating that data to her operations with the goal of improving both the frequency and severity of the losses. Patty, we're very pleased you could join us. Our next speaker is Paul Buckley, an individual who has been well known in the industry for his roles at Tyco and before that at Lucent Technologies. In fact, Paul won and was awarded the Business Insurance Risk Manager of the Year in the year 2000. And he's now operating as an independent consultant, in part connected with the Hanover Stone Partners Group. Paul has been in risk management, I suspect, his entire life, but certainly his entire career. And he started at the top, actually. He was a telephone installer. You may have seen him on top of one of those utility poles. And having that experience, he made the transition to a claims manager at New England Telephone, and then was promoted to become corporate claims manager at AT&T. With the breakup of the Bell system, Paul had a golden opportunity to become the first risk manager at Lucent Technologies. And among many things he did there was to really push the envelope of captives in their utilization, which I think contributed to his recognition as Risk Manager of the Year. Paul has been willing to work in education, not just within his company, but in the way he is presenting papers and materials, and has become kind of a senior statesman for a lot of risk management innovation and growth. Let me turn then to each of these two speakers and get them to give you a little of their own personal history. Paul, I'll start with you, and these are some of the questions that you might cover in your brief introduction of yourself.
Hi, good morning, everybody, and thank you for joining us. It's an interesting career that I've had. I don't come from an insurance background. I discovered risk management when I was within New England Telephone. I saw a job. I was spending some time in HR, and I saw a job being advertised for a claim manager, and in New England Telephone, that claim manager's job sat within the law department, and it sounded very interesting to me. So I decided to put in for it, and they decided that they liked me, and that was really my first start into claims. In the breakup of the Bell system in 1984, I was able to get over into AT&T and did that. As far as my greatest pride, obviously having the opportunity to take a $20 billion company and build the risk management organization into what I considered to be best in class. And, the Risk Manager of the Year award should not go to a risk manager, but it should go to a department. And that obviously, that department itself turned out to be, the best in class. And I've had that opportunity. I've been very fortunate in my career to have had two tremendous opportunities, one at Lucent and obviously the other one at Tyco. Everybody who remembers Tyco, I tell everybody I was AK after Kozlowski. I came in and had the opportunity to rework that organization to a fine organization that it is today and continues to be. Frustrations are always, for me, when you go into something new, getting the buy-in from, business segments and direction. Tyco was a company that had done things a certain way. It was built on acquisitions. I had 5 divisions within that corporation, all with different risk profiles, and so it was very frustrating to get down and try to show people the better way and how to do things differently, and have to fight those battles. Fortunately, I had great management support for that. Mentors, as far as I've had so many mentors throughout my career, personal mentors, business mentors, people who have taught and shaped me, into remembering, how to, to get through some of these frustrations that we talked about earlier, but to do it, and the expression that I remember the most is always take the high road, and I've been very fortunate to always keep that in mind. With that, Patty, I'll pass it to you.
Thanks, Paul. Good morning, everyone. It's good to be here. I appreciate the opportunity to speak to you. I got into risk management, as Rick said, after graduating from college with a bachelor's. Thought I'd go to law school, but decided to begin working, paying off some of those student loans. So I got into the insurance arena. Did that for quite a few years, and then ultimately secured my MBA in international business, and then looked for some other opportunities and moved out of the insurance arena to risk management with First Group. I've thoroughly enjoyed that here at First. When I started, we didn't have a specific risk management department, so with under my leadership, we were able to kind of put that under the one umbrella. So it's really been a great experience here at First in building this department. My greatest pride probably has to go back to the integration with First Group. We're 20,000 school buses large. We purchased Laidlaw in the fall of 2007, which was another 40,000 school buses plus a couple of other divisions. So we greatly increased our size and scale of our company. So my greatest pride really was when we combined those two claim departments, the Legacy Laidlaw, the Legacy First Group, post-acquisition. All in all, it was a pretty smooth integration. I thought the communication with the staff, between myself, my team, with our staff was excellent. We maintained and retained 100% of the staff that was going to be part of that going forward claim department, and we were able to place the folks that were initially displaced. But I'm very pleased with that and the communication and getting through that process. Probably the greatest frustration goes back again to that integration, and it kind of goes to the data, what Rick has got this call set up for to talk about. When we merged the two companies and ultimately the claim departments, Legacy Laidlaw had 20 years plus of claim data. First Group had approximately 10 years of claim data there. And merging that data, moving them between TPAs, which we did do, making sure the mapping was appropriate, et cetera, was an absolute challenge. I think all in all we did pretty well, but that was probably the greatest challenge that we had. Mentors over the years, I've had several, as Paul has mentioned, that have really helped me, shape me personally and professionally. The one that sticks out the most is the gentleman that I actually work with now out of the UK. He's the group insurance director. Brilliant person, financially savvy, really, it's just very, very smart. But he also keeps people in mind. He keeps communication in mind. And working with him, I've learned to work globally, across the pond, as we like to say, enhancing communication when you're not right next door to someone. Also, being part of the finance team, a no surprises culture is really important to us, and so trying to make sure that I set proper expectations, et cetera, again, going back to communication, has been key within this company and with this culture, and I really chalk a lot of that up to Richard for his assistance in that regard. Thanks.
Thank you both. That's a good foundation for us now to move into the meat of the program. In fairness to Patty and Paul, let me just emphasize that their commentary on these various points is candid and sincere, but is their personal opinions and does not necessarily reflect that of any organizations that they are associated with. Let me frame the goals for this program. I have the easy job of defining what we want to accomplish, and Patty and Paul have the much tougher job of actually meeting it. There are three goals that we're going to establish over the next portion of our program. First, the issue of what is success in risk management, how do you define it, and perhaps equally importantly, how do you enhance it? Secondly, Paul made a very good point that a risk manager is as good as his or her team, and how do you get partners, that is, people that are your vendors and your people that are delivering services, and your clients, which means the people that are internal to your organization, perhaps, how do they become part of this success formula? And lastly, we're going to jump into the future. Hard enough to do that one day ahead, but we're going to be looking out 2, 3, maybe even 10 years down the line of what risk management will be doing to be effective in that time frame. So with that, how do you define success? And I'll start, in this case, give Patty a chance to do that, and we'll then trade off comments between Patty and Paul as we move through these issues. Patty?
Thanks, Rick. Really here at First Group, the way that we define success, and I define success leading this department, is ensuring that I've got an optimal balance between my claims financing efficiency through the self-insurance piece and the appropriate protection against adverse severity through external insurance. So always taking a look at what that structure should look like is always key. Ensuring that I've got the actuarial projections coming in, that I communicate that those are understood, and that we're reacting to that is also key in what we would characterize, or I characterize, as success. Speaking to what Rick had mentioned earlier, it's also important and incumbent upon myself and my leadership team to ensure that we're producing highly effective management information reports to the First Group executives, to the group management folks, to the operating divisions, so that they can, as we talk about here, react to lessons learned, look at the trends, so that we can, again, reduce the frequency and severity of those collisions on the roadway, and the frequency and severity of our staff members in their shops, et cetera. We also want to have best-in-class claim handling, and minimize those costs and pay the right dollar on each and every time with regard to those claims. So that's really how we define success here.
Paul, you want to provide your comments, please?
All of the above. I mean, I can't disagree with anything that Patty just said. You know, one of my tools is communication. When I see communication back and forth between the business segments and my team, that to me is a real measure of success. One of the things that I look at is if in your organization, when people say risk management, and they start to call it the insurance group, that's always been a big frustration to me. In one of my first memos I wrote at Lucent Technologies, I said I wanted the risk management organization to be known as business problem solvers. And you can't do that without the communication. I wanted budget stability for all of my business units and segments so that the predictability was there. Patty mentioned actuarial analysis and the data mining that we do and that we've been very successful at in allowing us to be predictable so that we live in a world of no surprises. So what it is to me, and it kind of goes down to, is there good communication between senior management, business segments, and the risk management organization all around that? Is that circle complete? That's how, one tool that I would use, including all of what Patty said. So.
Okay. Well, Paul, we're going to keep you on the hot seat then, because if you define success, then you have to know when you've arrived. So what are your thoughts on that?
It's a simple one-word answer to me: never. And that's probably sounds like a hopeless situation, but it isn't. Because at each point that you believe that you've arrived, you should be now setting a new, goal and objective of how do you take it to the next step, and how do you, enhance that. Because as we all know in risk management, things change on sometimes a daily basis, and so you have to be flexible enough that that when you kind of get where you think you are, you're ready to take the next step and break through the next ceiling and become more and more integrated within your corporation. Patty?
Yeah, I would agree with you, Paul. I don't think you ever necessarily arrive or get there. There's always continuous improvement. I think the complexion of the business, and I've seen it with our business, and you probably have as well, Paul, as your business changes and evolves, the department needs to change and evolve. As we look at the data and feed that back to operations and reduce frequency and severity, other things crop up. There's other areas that you can impact a little bit further. Also, the environment changes, the business climate out there, the variables in the environment. We put in training programs and try to ensure our drivers are best in class and that our folks on the job are operating appropriately every day. But the environment changes. For instance, out there in the world now, there's folks behind the wheel that maybe are texting or they're on their cell phone, etc. They come left of center and strike, our vehicle head on. Those are things that you think, can we do anything about those? But I think we can. We get involved in the community, get involved in the schools, get involved with National Safety Council to spread the word and that sort of thing. So those are some things that I think you just never totally arrive. It's always a continuous improvement.
Patty, you've covered a few of these points, but just to bring it back, you talked about continuous improvement, and so how do you keep raising the bar? How do you discern what is the next goal for risk management?
I think you have to ensure that you understand what the goals of your company are, what the divisions you support are, and ensure that you're aligning with those goals. I think you have to set, and I think Paul talked about it a moment ago, stretch goals. You need to put stretch goals in place to keep people focused on trying to get to that next step. And you have to have a scorecard, and you have to keep checking the scorecard. And again, going back to some of the data and that sort of thing, that's why I think pulling in that data and making sure you're pulling in those key metrics or those key measures to see how are we doing, checking the scorecard, and then taking those steps for continuous improvement. What's your thoughts on that, Paul?
Raising the bar is just part of the everyday change. An example for me was in all of my annual goals and objectives, I would always say I was going to earn, through risk financing techniques, a penny a share. And that, and I can tell you I never made the goal, but sometimes I would get 7/10. And people say, well, why would you put a goal out there that you may not make? Well, it's 7/10 of a penny is a significant amount of money. It forced me and my teams, every time we looked at doing something, how do we finance this risk? Should we use the captive? Can we use the captive? And then should we use the captive to do those type of things? So establishing, stretch objectives, as Patty said, you can't be afraid, and you can't always set objectives that you just know you're going to make. I mean, you can't be afraid to continue to strive for that improvement, and that's raising the bar, even when you put yourself at risk. Now, I don't mean to say that you put out something that's absolutely crazy, but at the same time, you put something out there that you're working towards. And so with that, I'll shoot on.
Well, let me throw out a question to both of you, just very briefly, but I've had it expressed in very clear terms by some very senior executives that risk management does not run, and you can insert the name of the organization, this organization. But on that basis, and I think we recognize that, probably in the Tycos and Lucents and even First Groups. But what can you do to influence the business of your company, not just the claims aspects, but actually become a factor in the business success of your clients, your operations?
I'll take that first.
Yeah.
Obviously, being part of finance keeps you financially focused. It does me. How do I become integral in what, in fact, we're doing is when I see people and I make sure that as an organization that we're thought of not as an afterthought, but as a in the beginning, so we can get involved. For example, I worked on many mergers, acquisitions, and divestitures throughout my career, and that's how you get into the C-suite, as they call it today. It's incumbent upon us as risk managers to define the organization and its role within the company, and you can do that either by saying, hey, I'm going to always talk insurance so nobody understands me, or I'm going to take it upon myself to integrate myself into this organization, whether it be finance, safety, or whatever. But it's incumbent upon us to learn their language and take it so that we become, their, advocate. Patty?
Yes, I would agree with you, Paul. And Rick, it's a great question. We can, as risk managers and leading the risk department, help the business grow. I think, and we try to here within our department, enhance the brand of First Group, whether it's Greyhound, one of our divisions, First Student, or First Transit. We can enhance the brand when we meet somebody on the roadway through an accident. If our staff can reach out to them, show them care, concern, empathy, and move that matter to a timely resolution. When somebody gets struck by a driver driving a First Student bus, don't they have a much better opinion of First Student and that school bus company by the way they were treated in the handling of that claim? In addition, I think, as Paul has said, if we can run our departments efficiently and make sure that we're handling matters best in class, we're getting the right structure, insurance structure for the company, we can give our divisions a competitive advantage. And that's what we try to do here at First with my department as well. When I've got folks out there on the commercial bid teams trying to get new business for either school bus, or transit, et cetera, the bid teams reach out to us. And we can, because of the structure of our insurance program, tweak those the insurance for each of those clients in such a way, or utilize the captive in such a way that it makes us more marketable and gives the client the chance to say, hey, we want to give First Group a nod. So I think we can grow the business in those ways. I think continuing to make our company aware of the various risks that are out there through communication and collaboration, not with a hammer, I think can also make a difference. And if we manage our departments effectively, give the divisions and the company as much P&L stability as possible.
Excellent. Thank you very much. Let's move on to the topic of partners and clients, which I think, as I said, and I think would be shared by both Patty and Paul, are the building blocks of success. What I'm going to do here, I'm going to bring up the slides and give each of our two panelists the opportunity to address these points in order. I'll start with Paul, and then Patty will follow with her thoughts on these particular points.
You know, partners, you know, and you look at that list, the brokers, TPAs, carriers, information services, they're an extension of your risk management organization and therefore should be treated as an extension of your organization. They work for you, and as we go forward, I can't do business or could not do business, you know, without the brokers. A lot of people step back and they say, well, the broker this, the broker that. No, it's the broker has access in the markets that you can't access. They are your service partner. Your TPA is your first face into a claimant. I mean, and if they're not, whether it's your employee in a workers' comp or it's a liability claim, that TPA is the first person that your people or whomever the claimant is going to deal with. I can't, you know, you have to invest in them just like you would invest in you know, if they were part of your team, if they were your employee. Carriers, you know, you have to have good carriers. You have to be able to, you know, depend on them, you know, and make sure that you've got best terms and conditions. And so, again, especially internationally, we at Tyco and at Lucent dealt a lot with international and local policies and making sure that they were issued. You know, the broker and the carrier have to do that for you. They are a lot of times the only people that the local people would know. Information services is a great one because the other three are easy. Information services, you know, people like Shelter Island, you know, through the years have allowed me to take a deeper dive into, you know, fixing the problem, not the blame, allowed me to create Pareto points and looking at the data and how does the data, you know, impact and where is it impacting and how can I make that better. So information services is a critical component because especially as we move forward today, you know, data is, you know, the data doesn't lie. The data, you know, over the years will tell you whether where your problem is and a lot of times can tell you how to fix that problem. And that's, if you treat the data that way, and Patty used an interesting word a few minutes ago when she said risk management should not be a hammer. You know, this allows you not to be a hammer, but to go in there and say, look, here's what we're seeing, here's what's happening, you know, we can fix this, and here's how we can help you fix this. And you can then, you have a base, you can measure it, you know. How do you maintain peak performance? You treat them like, with the respect that they need to be treated with, no differently than you would treat somebody that was absolutely on your staff. I am a firm believer in bringing them into my goals and aligning our goals together. You know, that gets thrown around a lot, but you know, I never treated any of those as anything but as if they were my employee. I would have yearly meetings with every group that I had together to make sure that we all were aligned on the same page so that everybody knew what our objective was. When do you part company? There's a lot of times that, they either just can't do it because you've outgrown them. It's a simple thing to think about. Does not have the skill sets that you need to take the thing into an appropriate direction or to get you where you want to be. With that, I'll pass to Patty.
Thanks, Paul. I think what you said with regard to, going back to this first bullet, what makes good service partners, business associates in your team. These business associates, business partners, our brokers, TPAs, information specialists, etc., are extensions of our team. There's no way that myself and my leadership team in our department could do all that we do without having this extended team. But I think our business partners, vendor partners are absolutely extensions of the team and help us do the things that we need to do. I think it's important to have the good service partners and ensure that is to make sure your goals are aligned. I think it's really key that your vendor partners know what your goals are. Where are you trying to go? So we've talked about raising the bar previously. You want to look at where you've been and where you're going. I think you need to have those conversations with your business partners, and it sounds like Paul does that when he had the yearly meetings with his business associates. We do the same thing here. We really want to be best in class, so we want our business associates and business partners to be striving for continuous improvement within themselves to be best in class. And again, I think the better we get to know each other, the better they can advocate on our behalf. Maintaining peak performance, I agree again with what Paul said. You need to be open, honest, and respectful with the business associates and business partners. Constant communication will help you maintain that peak performance. Again, I've spoken to it before, is check the scorecard. I think you need to have a scorecard. You need to check the scorecard and do that with your business associates so that they can see where we stand and where we want to go. Drift tends to occur. It's just natural that you drift off the goal or you drift away from some of those keys. So continuing to update that scorecard and checking the scorecard, I think, are key. Additionally, I think you need to make sure that the vendors are evolving and changing with the needs of your company. And that kind of takes me to when do you part company. I think if your business partner is not growing or evolving with you, and I think Paul talked about it as maybe a staff member that maybe isn't, he kind of put it in those sorts of terms, and I think that would be similar. If that business associate is not changing and evolving as your business is, then I think that might be a time to part company. I think good governance dictates that you have periodic RFPs. You need to test the market. You need to see what's out there. You need to check your pricing. I will say, though, that when you look at the vendor partners, we certainly, price is a component. It is not the priority component, though, that makes us make a decision. It really is, what does that vendor partner bring to us? Are they on the cutting edge? They're out there with their ear to the ground in that industry. Are they bringing the latest and greatest and the newest, ideas to us and that sort of thing? I have found with the RFP exercises also, there are things that other business partners and vendor partners have out there that maybe your current partner was not aware of or didn't bring to your attention. So the RFP exercise is very helpful to show you what's out there and say, oh, I think we would like to tap into that. Those would be my thoughts, Rick.
Rick, can I just jump in one more time? Patty, you said something in yours that was very important that I thought just needed to be reemphasized, is that, when you go out on an RFP process, and I agree that that's good governance, but sometimes we turn what we're doing into a commodity rather than, than what we're looking for as best in class. So it isn't always about price unless that's the type of structure that you want to have. So I just wanted to retouch on that, Patty, because I thought that was very important what you said.
Well, I think it's a dilemma that anybody logically faces, and I think one of the challenges looking at it from a vendor that's in the information business is how do you justify, if you're going to pay more and create not something other than a commodity, how do you justify that enhanced service in terms of benefit to the company? Which I would now like to have Patty lead us in a discussion that's more focused on the internal side of what risk management is doing to build that partnership with your own clients, your own operations, and with other groups like the CFO, legal, and HR.
Well, great. Thanks, Rick. We have a very strong relationship, and it gets stronger every day with operations. It's key as we liaise with the operations to ensure we're allocating the insurance or risk costs appropriately. It's important to let them know the score, let them know what the cost of risk maybe is to their particular operation or to their business. We need to be an advocate for them. So when there is a loss that happens, we need to make sure that our claims staff are doing thorough investigations and really being a true advocate to find out what actually happened. In our view here at First Group is operations run the business. They make it happen for us. They're the ones out there earning the revenue every day. So it's important that we support them. As we can find pieces of information through the data and diving into the data a little bit more, share that in a collaborative, informative manner with operations to just make us better each and every day. Working with the CFO, I think it's always important to know what's driving the CFO. I've worked for several here in my career with First Group. Some are very focused on the actuarial numbers. How did they get to those numbers, and what assessments or what judgments did they make? What levers can be pulled to tweak those numbers? They really want to understand the why behind that. Many of the CFOs I've worked for have been very close to the pension program, so they have a lot of understanding of the actuarial, so that's a real focus for them. Others, though, are more focused on the cost to the business and making sure that it's allocated properly, etc. I think it's just really important to know what's driving your CFO and what's important to him or her, and then working collaboratively with them to get them that information. Legal, we have a very close relationship to legal. We partner with them on contracts for our new business. They send us over the contracts, and we take a look at the insurance pieces of that, the portion of that. We tend to hand the ball back and forth between ourselves and legal when it comes to our new contracts and that sort of thing. And human resources, absolutely key. We're having a close working relationship with human resources, especially if you have in your workers' compensation program, as I'm sure all of you do, a strong return to work process, making sure that that HR has a piece of that and is playing into that you've got the interactive process in place when there's some permanent restrictions that come in from the doctor and that sort of thing. Additionally, with human resources, and we're trying to do that a little bit better here, we're not where we need to be, is tapping into some of that data and having that data maybe feed directly into our risk management information system so that when a claim comes in, that location manager who's inputting that data doesn't have to retype information. We get an HR feed in that lists the name of the employee, the name of the driver, how long they've been with us, that sort of thing. And also take a look at that, make sure we've got their date of birth, the time with the company, etc. And then we can use that to look at some of our data on claims trends and sometimes feed that information back to operations. So that would be my thoughts on how we liaise with these various departments. How about you, Paul?
Well, I'm very fortunate because, I spent most of my career in the Bell Systems and came out of operations side of the business. So, as they say, I feel their pain. Operations is, as you say, is the critical component. These are the people that are out there doing the job, making the money. So without operations, we don't have a company. So I can't stress for you, no surprises for operations. Some of my history, in some of the things that I've seen is you'll have and I'm just picking an auto accident that happened 3 years earlier, and it was under a self-insurance piece, And now all of a sudden you're going to somebody who's they've never even weren't around when the accident happened, telling them their operational budget is going to get hit for a couple of $100,000. That could, that's something that just should never happen. And unfortunately, I saw it happen too many times in a company that I was at. Why does that happen? It's because, people didn't set their reserves, do whatever they were supposed to be doing for whatever the reasons. I came out of the CFO organization. I reported directly to the treasurer at Tyco and at Lucent, so I was very fortunate to be in the finance organization. One of the things when I joined Tyco was they referred to the actuarial analysis as a black hole, and it was common amongst all 5 segments because they had just given them a number and said you have to book this in your FAS. And it was a real education process to walk the segments through the actuarial projections and how they came about that by not reserving in an appropriate way, but doing step-by-step reserving was costing them significant, surprises every year at the end of the year when the actuarial analysis was completed. That was a major challenge. But the CFO, the finance organization, is going to tell you how to book things, and I mean, being part of that is a fiduciary responsibility. Legal, I worked well with legal, very well at Lucent. At AT&T, as the corporate claim manager at AT&T, I actually had legal come to me to understand the process by which we managed the tort litigation that was part of our day-to-day operations, because they couldn't get the numbers that we were doing, and we actually worked with them to help them remodel their system and saved them millions of dollars in that direction. Well, and the reason is obviously they were doing some things that just didn't make a lot of sense. I'm very, very close to legal. I doing until I was in the legal department. You can't run a business without legal. As Patty said earlier, we review contract language to make sure that we can comply with the pieces that are out there, the insurance needs of that particular, sales group or whatever it is there. But legal is just with these and human resources. I mean, human resources is a critical component in everything that we do with the employee. Patty mentioned the return to work. It's how do we make how do we turn that into a positive? And so my HR group, all 3 of these groups here, all serve operations, and we're just part of that team that has to function as one to get the best performance for our operations or our business segments, whatever you happen to call them within whatever your organization is. But it's how do we work as one to get the best result.
Very good. Well, let's move now into the future. Obviously, that's a little tougher than the present. I have my own comment about watching risk management for 30 years. Is that, to me, the biggest change that has occurred has moved the organization from being an insurance buying company organization to risk management becoming really a financing arm that's gotten into very creative tools, as we all know, from captives, et cetera. The thing, though, that I think is really sitting out there as a great opportunity is not just to communicate our data financially, but as Patty indicated, to do so operationally. People who run these major divisions and so forth, they're not actuaries, and they really need the insight to do a better job of controlling claims, not just financing them. and I think that's one of the futures that I will see in the next couple of years, is risk management groups taking the data they have and utilizing it more creatively. Specifically, we all focus on the people who have claims. That's a routine process. What I'd like to do is focus more on the people who don't have claims, so you can build a more complete model of your organization, at least from the workman's comp viewpoint, and better determine where there's opportunities to learn from what's good instead of constantly focusing on what was not so good. So with that, Patty, if you could give us your thoughts looking at it just a couple of years out, where risk management is headed.
Sure, Rick. Really, being positioned for a hard market, I think, is something that is in my mind, and is something that we'll be looking at just a couple of years out. Looking at risk financing alternatives, I think what you said is exactly right on, Rick. Looking for other ways, to manage the risk and finance the risk, the creative ways, etc. Expansion of the captive. That's what we're looking at, various expansions of the captive for coverage, but also to enhance our employee satisfaction. If we can enhance the captive and build in so that we can maybe provide the insurance for our drivers, auto insurance, and give them a break on cost, or homeowners insurance, things like that. So those are a couple of the things that I would see kind of out there in the future, just a couple of years out, Rick. How about you, Paul?
Yeah, in the short term, I've been through hard and soft market cycles. Probably, I remember the 83, 84 liability, cycle where people couldn't get liability coverage. Then I've seen it go into the soft market. So as I look at that today, I see that hard market cycle coming, everything that I read. The question is going to be, does the risk manager have his organization prepared for that going forward? Did they have they prepared them properly? Because if they haven't, then there's going to be problems. Now, in the short term, data, as Patty was saying, is critical to help you understand your costs. In the past, I've seen people take what I call a shotgun approach to the data, which just scatters it all over there. One of the things that I have tried to do, especially with Tyco, was, and I think Rick would support what I'm saying here, is that I now started to take a rifle and aim at things, create, profiles, with only X number of dollars. We talk about the comp arena. With only, you want to try to maintain your costs, and you have to look at what pushes a case, for example, over a certain dollar value. What are the historical markers around that? So when you see that profile, you could take and manage that claim faster, quicker, earlier, not let it get to that point that it's going to reach that thing, and that becomes a profile, and you can build with the data that's out there today. You can build that profile. So in the short term, I see more and more people doing that, and that way getting more control around your frequency and knowing which ones have potential to be severity. I see that as just more and more data mining over the next 2 to 3 years, because as the hard market cycles its way in, we're going to have to find ways to control costs.
Very well said. Now let's, our concluding issue is taking a longer point of view, but as this indicates, how do you see the risk manager 2020, and what will be the impact of ERM on that role? I think we're starting this one with Paul.
You guys, everybody on this call has great skill sets when it comes to evaluating what I would call insurable risks. we have some real significant talent in that area, and we've been doing it for very well for many, many, many years. The risk manager in 2020 hopefully will be all of you that have taken your skills and made them transferable to non-insurable items, such as, one of the things at Tyco we were able to do is we had an ERM team, and where you had 5 divisions, and for example, we're talking about hedging here. One wanted to hedge something that hurt them, but the actual cost helped another. So when we looked at it from a corporate perspective rather than a segment perspective, we had a natural hedge built in, and that therefore it wasn't going to get hurt. But that risk manager of the future, enterprise risk management is a word that's been being thrown around for years, but boards of directors today, because rating agencies are looking at it, are now starting to form ERM committees within the board of directors, and they want to understand that the corporation understands its risks, not just its casualty risks, its property risks, because those are fine, but you're now being asked to look at, Patty mentioned it earlier, brand risk. I mean, what happens if there is a major issue that, hits the news? How do you deal with that? And ERM, and we should all be part of that. We should all be part of the ERM team. I mean, it's a natural place for us to evolve to. Patty?
Yes, looking into the future, I think piggyback on both what both of you gentlemen have said, continuing to leverage the data, mine the data, focus on, as you say, Rick, the folks that aren't having the claims, to try to, find out where's the risk, to be proactive with that. Or with the data mining, when folks do have the claims, have mined the data to find out what's the better maybe treatment modality, different things like that to move somebody back to work quicker, that sort of thing. Additionally, working with the community and safety aspects. Maybe it's something you can't necessarily control, as I said, with the folks out on cell phones on the road and texting while driving and that sort of thing, getting some community involvement. I think that's, in the future as well. There can be a lot of gains from that. With regard to ERM, I think what you said, Paul, is exactly right. We have various skill sets as risk managers, and being able to transfer those skills can really help the businesses in that whole ERM area. Help the businesses understand, do they have an appetite for something? We do that all the time in our arena, helping them understand, do they have the appetite, and helping them quantify that. We're financial people as well, and I think doing that is going to be key in the future. Fully understanding the current conditions in which our organization, our business is operating, the internal and external items that will impact us, impacting the risk, identifying the risks in the various departments, not just in the arena that we've touched. Those would be my thoughts going forward, Rick and Paul.
Great. Excellent. Of course, we're opening these now to questions from the audience, but before we begin to deal with those, I just want to give a personal and very sincere thanks to the efforts both Patty and Paul have put into this. While this might seem like it's a live presentation, but believe me, I know they've put a lot of work in preparation and thinking about and rehearsing these various points. So for that, we are all appreciative. So thank you again for participating. We will be listening to your questions, and we'll address them as soon as they are available. So thank you very much. Have a great day.
Thank you all.